This is an audio recording of the Lendit Fintech Weekly News Show. The show is streamed live on Lendit TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the Lendit News team and a special guest discuss the most important fintech news stories of the past week. Good afternoon, everybody. Welcome to the Fintech Nexus Weekly News Show. My name is Peter Renton, Chairman and Co-founder of Fintech Nexus, and joined, as always, by my good friend and colleague, Todd Anderson. How are you doing, Todd?
I'm well, Peter. How are you?
Doing great. And our special guest this week is none other than the legend himself, Ron Shevlin. How are you doing, Ron?
I'm doing great. Thanks a lot for having me back. I have to tell you guys, I really do appreciate the opportunity to do this. And whenever you call and ask, it just confirms that I didn't screw up that badly the last time that I get to come back. So
Of course.
Oh, we love having you here.
Yes, indeed. So let's get right into it. We've got a lot to cover today. I'm going to start with the Federal Reserve, and this is something that has been talked about over probably the last several years. With it's basically Federal Reserve they're finalizing guidelines for access to their master accounts and so this is something that fintechs have been asking, not just crypto companies, but fintechs have actually been asking for this. And they've basically brought in a layered approach. Obviously, the crypto people, I think, we've had Caitlin Long from Custodio, who's famously sued the Fed, and now I don't know what it's going to mean for her. But anyway, it's going to give that she wants access to this master account at the Fed, and this opens the door for that. I thought it was it's been a long time coming, but it looks like we might be making progress.
I guess we still need to see exactly what the guidelines might be. I don't think we've seen the full details on it. It seems like it's opened the door for them, but they're still being a bit coy on exactly what they're looking for and what the tiered approach is, and what that extra scrutiny will be from like the state chartered, like for Kraken and Custodia, like the crypto industry has been asking for some time is just clarity. Right. And I hope this gets them further to that, because I think there's a lot of crypto firms that want to work within the guidelines and the systems that are in place, but they're unsure what those systems are, and hopefully this helps get them to that clarity.
Yeah, I totally would agree with you on that, Todd, but I do think that at the least there's some really good signs and things that come out of this in terms of the depoliticization of the process. Right. Has been very, opaque process in the past. Now, somewhere says, they were struggling with, like, it's kind of de-transparent. What is de-transparent or untransparent? Someone said, you mean opaque? Yeah, that's it. That's the right word. So, that I think is a huge step. But I do think we're still going to see some grumbling from the crypto companies and the fintechs, because that tiered approach really tends to favor those companies, institutions, whatever you call it, whichever the right word is there, for those that have, charters, those that are FDIC insured. And, you can make an argument that that's the right levels. But I still think, I would kind of look at it like, well, the door is ajar for the fintechs, but the cryptos are going to have to do some pushing to see some daylight there.
Right. And it's obviously it might be a long road before approval is granted. So we'll be following that one. Anyway, I want to switch, Ron, to a column that you wrote this week, and something I've been following along on as well. And this is the whole idea of what would an Apple bank account look like? And there was a tweet, I think it was just a week or two ago, probably a couple of weeks ago now, that that really put it out there, saying, okay, let's sort of brainstorm in here and see what it looks like. And I know there was a couple of people that signed up and wrote about it. I know that I think one of was Alex Johnson, one of your former colleagues, I think, Ron, and then we also had Itay from the unit write about it, and you've written about it as well. So maybe I'll just let you describe, why you wrote about it and what you wrote.
Yeah. So listen, I hate to ever take issue or disagree with folks that I consider friends and have a lot of respect for, both Alex Johnson and Itay at Unit, but both of their responses, and it was Benedict Evans, who's a fairly well-known blogger, tech analyst. I think he's made some big investments in the past that has gained him some notoriety, and he's a great blogger. I get his stuff every week, and he kind of put out there a tweet that said, "Hey, fintech folks, what would an Apple bank account look like, and how would it work with the Rails?" And both Alex and Itay had some really detailed graphics and explanations, but I came away reading that thinking, man, it sounds like you guys are just taking every conceivable checking account feature that there ever has been mentioned or defined and threw it all into the pot and said Apple's going to do everything. Mm-hmm. And my feeling was like, nah, I don't think that's the way Apple approaches things. To me, the Apple design ethic or ethos is simplicity. And they, more importantly, is that I kind of looked at it like they abstract the complexities of whatever they're doing away. Mm-hmm. You don't have to push a million buttons in an Apple app. It's much more intuitive, much easier. And so my take was that they wouldn't throw everything into an account, but and I think they would challenge the notion of what an account is. And I think this is where the real innovation and reinvention of financial services and banking in particular needs to start with is, look, we are hampered with this idea that everything is an account. We have a checking account, a savings account, a brokerage account, a million payment accounts. And who's out there that's going to really rethink that process better than anybody else? And it's probably Apple, because they start from a completely different design perspective and probably more of a first principles approach. So I don't think they're going to start with an account concept, and I don't think they're going to throw everything in. I think it's pretty much a jobs to be done kind of, no pun intended with Steve Jobs, is a jobs to be done kind of approach where, what are you trying to do? Well, I need to move money from me to him. Okay, then we'll figure out how to do that the best way. You want more interest on your savings. This is what it takes to do it. It's not a high yield savings account. This is what you have to, maybe you pay for the higher interest, or you do so through behavioral incentives and things like that. So, that was my take, is that I think Apple would come to this challenge with a completely different mindset, not a, how many functions can we throw into an account?
Mm-hmm. Mm-hmm. Todd, any thoughts?
I'm more on the side of Ron in this one, just because Apple doesn't do things that are fairly typical, and while the ideas they had were a lot of them, it felt more like just typical accounts that were maybe with an Apple logo on it essentially. And
right,
while I don't know what Apple might be thinking, and they'll probably surprise us if they move in this direction, but I think it would look a lot closer to what Ron is thinking than it does what the other guys were thinking.
Yeah,
guys, go ahead, Peter. Sorry.
No, you can go, Ron.
Oh, I was just going to say one thing that I had written about and I've gotten absolutely zero feedback or pushback back on, and I'd love to get you guys' opinion, is I thought that if they were to do this and attack this problem, that Plaid would be a great candidate for them to acquire. And I think regardless of whether or not they try to redesign and reinvent the basic banking account or checking account, that could still be a great acquisition for them, because it would enable them to then make those connections to all the fintechs that they could then bring together and integrate into this. Nobody's kind of told me, God, Ron, you're crazy. What the hell are you thinking?
I don't think you're crazy at all. I feel like it all depends. Like what we don't know is how much Apple wants to get deeply involved in financial services. If we suddenly find out they're approaching Plaid and they're going to buy Plaid, that's the indication we've been looking for, because they've done they've got a card, credit card, they've got Apple Pay, they've been playing around the edges, but they haven't gone all in, and
they announced the buy now pay later project. They acquired Credit Kudos.
Yeah, I think they're on their way to going a lot more all in.
Yeah,
and I think what they've done so far is they've gone all in on the Apple ecosystem. And I think an acquisition of Plaid would go all in on financial services, because that would just take Apple, and like you said, Ron, it would just immediately connect it to hundreds of fintechs and all the banking connections. I mean, it would unearth probably something that we haven't seen before in financial services if they were to do that. And I think their focus thus far has been very much on keeping people in an Apple ecosystem. This would go outside of that, so I'm not sure.
I mean, I think they could still keep them in. I mean, there's a way to, like what Steve Jobs always did was sort of make the complexity disappear, and that's that's kind of how they do it. Anyway, we can't talk the whole half hour about Apple, even though
we can.
I'd love to. We have other news. There was a really interesting piece in The Economist this week that something that we've talked about on the show here a bit. It was basically, can the Visa Mastercard duopoly be broken? ? And it really basically said that yes, it can be. It's like, because the thing that's crazy is Visa and Mastercard are two of the most profitable companies on the planet, not in financial services. Look at their net profit margins. That it is staggering. And, on the Jeff Bezos mentality that your margin is my opportunity. There's massive margins to be had there. Lots of companies looking to it. We got, Stripe, Klarna. There's also like the Figure, offering. They're all trying to create these kind of different types of payment rails. Apple could create a different type of payment rail. So I think it's one of the most interesting questions in all of finance is what's going to happen with these payment rails, and love to get your thoughts.
I'd like to hear Ron's thoughts first. I mean, probably banking and Durbin Amendment and stuff better than anyone out there.
Okay, a couple of thoughts. Number one, can the Visa Mastercard duopoly be stopped or whatever? The answer is yes, absolutely yes. The question is, how would that be done? And I think there's two ways that it would get done. Either some big bang regulatory approach, or through over time chipping away with alternatives. I think the merchants want to try. The merchants and to some extent sort of the startup competitors kind of want the regulators to kind of blow it all up. Not going to happen. Right. Not going to happen. Yeah. And so the I think will change over time. Look at the history of business. No matter who's got a monopoly or a position, has almost always at some point in time been challenged through technology change and other things that have happened. So, to think that 100 years from now, Visa and Mastercard are still the duopoly is not necessarily very realistic. Mm-hmm. But the question is like, how do you continue to chip away and find the pieces of it so that you can grab? I think what the merchants have done, and more recently, that whole merchant customer exchange thing was absolutely ridiculous. 6, 7, 8 years ago. But the approach that the Starbucks have taken to create stored value cards and things like that let people load balances on, chips away at the duopoly, creates alternatives. And I know you didn't want to talk about Apple for 30 minutes, Peter, but reality is just like as Todd says, is like the kind of things that Apple is doing is the kind of thing that's going to chip away at it, and perhaps a lot faster than what the merchants are doing. But the answer, I think, to the fundamental question that the Economist raises, yes, it can be broken.
Mm-hmm. And I agree. I think there's no way that it's going to be regulatory driven. I think regulators might put some incentives to help chip away, but there's no way the regulators are going to come in and just whack Visa and Mastercard and immediately spread that out. There's not a chance at that.
Yeah, one last thought though. One of the things that really just ticks me off about the regulatory approach in this Durbin 2.0 is it probably hurts a lot of community banks and credit unions a lot more than it hurts MasterCard and Visa. So, the way they kind of position all of this, and then, the merchants with their nonsense BS about, interchange is the second biggest thing after wages. I don't know. It seems to me my numbers show that, there's about $250 billion worth of advertising that's happening. So if you merchants want to improve your margins a little bit, why don't you just stop advertising a little bit and, quit blaming interchange for everything, and then go back and start taking cash again. See how much better that is for you.
Right. Well, I think but the point is, I think we have the interchange fees are high. They're much higher than they are in the rest of the world. And I think that's that I can't imagine that will stay even by the end of the decade. I imagine it's going to be vastly different. So
yeah, I totally agree.
Yeah. Okay, we're going to talk a couple of stories now about lending. This is in the Wall Street Journal. We had the Affirm CEO, Max Levchin, had him speak several times at our events. He basically was saying that Affirm doesn't get as much respect as what he thinks it should. Feels like they've got really solid underwriting, and what he's almost rooting for a recession, because he says that's going to silence the doubters, because they're going to come through a recession just fine. It might be a case of be careful what you wish for, because certainly a lot of people are talking about recession, but he is very much of the opinion that Affirm is doing a better job than everyone thinks.
Yeah, I mean, it's going out and basically hoping for a recession to prove your business model is quite the cocky way to go. But I mean, the early indications are that the fintech lenders aren't that much smarter than the banks. I mean, yes, I'm sure there's some out there that do a phenomenal job and are in line with where the banks are, but the numbers right now I don't think wholly support with what he's trying to say. Now, maybe in a recession we'll see, because everything goes up in terms of bad news for lenders in a recession. But you can't tell me right now that what they've shown to date has proved out their business model.
Mm-hmm.
I think there's a lot of other stuff kind of going on here that's just too bad and disturbing. You look at a firm stock price and say, it's down 70%, and boy, that's really negative, and that's this is not a good sign. Well, 70% down from what? From an incredibly unrealistic valuation to start from. Right. So maybe where they're at is actually fairly valued and positively. I mean, if we didn't have the ridiculously high valuations, maybe this would still be a strong valuation. I do think his choice of words around hoping for a recession was kind of misplaced a little bit, but I am a big Max Levchin fan, and I'm generally a fan of where buy now, pay later could be going, which is not as a pure lender, but as a tool that actually helps the merchants sell better.
Right.
It actually is a way of introducing payments as a way to influence the choice of product and provider. And I think Klarna is very attuned to that type of thing, Afterpay as well. I'm not sure if Affirm has kind of been on that path as much. And I think to your point, Todd, about them not being any smarter than the banks, I think that's actually spot on. I think, and any good lender will tell you, it takes a year for your models and risk profiles to kind of take hold and gel. I think where the buy now, pay later market is going in general, though, is towards deeper specialization and focus. I think sort of as a general consumer products goods provider of BNPL, they're going to be kind of challenged, because there'll be providers who will focus in on fashion and luxury goods, those who will focus in on other areas, and we already see this. Take Lone Star Technologies out of the Philadelphia area that focus in on home repairs, heating and AC type thing with those kind of providers. they're very specialized in terms of the buy now, pay later type of services they provide, because they underwrite that every day in and out, and trying to underwrite everything from, guitars to soap, I think is a bigger challenge.
Right. Okay, moving on to a related story. We also in the Wall Street Journal was talking about rising interest rates putting the squeeze on fintech lenders. A lot of talk about Upstart. I mean, Upstart's been in the news a lot since they had their earnings, a couple of weeks ago, and they've had worse performance for their underwriting than I think they expected, causing the demand for their securitizations. It's weakened. Spreads have doubled. They had their borrowing costs increase. Other fintech lenders, I mean, if you don't have a fixed rate that's been set before interest rates went up, then you're paying more. And let's face it, every fintech lender has warehouse lines with banks. Some of them have long-term agreements in place, which means that they're not affected in the short term. But if you've got a variable rate agreement in place, your cost of capital is going up right now, and that's what we're seeing, I think, across the board.
I mean, it's no secret why Lending Club and SoFi bought banks to shore up their funding sources. Right. I mean, part of the business model that originally they helped pioneer. When times hit tough, the funding sources either dry up or get very expensive. And then ultimately, where do you have to do? You have to pass that along to the consumers or the borrowers. And then you have to adjust your models. And I think the traditional fintech lenders, as we might want to call them now, are feeling the pressure of that business model. And I think more should look at the Lending Club SoFi avenue as a potential long-term play, and moving away from just lending as a core product, because they get squeezed, and the monoline business is not what it once was, especially as we're heading into a recession, and you're going to see probably more consolidation than you already have.
Mm-hmm.
Yeah, quick point I just make. I think it's same story as the BNPL, bit of an overreaction. I mean, it's certainly hard, but the well-managed fintech lenders are going to come out of this and ride the next wave. It's about managing the business.
Right. Okay, now we've got a few crypto stories here now. Let's see. We'll start off with BitGo, because BitGo, this was the first big crypto deal. Galaxy Digital announced last May, that's 15 months ago, that they were going to acquire BitGo, and they were already a partner, like an investor in BitGo, and $1.2 billion deal. Obviously, the crypto winter came, and suddenly Galaxy says, that's not really worth $1.2 billion, I don't think. And anyway, they've tried to get out of the deal on a technicality. BitGo have not happy about it, and they're asking for $100 million in breakup damages. And so this, it reminds me a little bit of the Elon Musk Twitter thing at a much smaller scale, but it's a deal was made, and now someone's getting cold feet.
I mean, so some of this probably goes back to the last couple of years and just the insane valuations of everything. And when everything finally came back to earth, so some targets didn't look as good as they once did, and I think that played into the Twitter thing. Their Elon's initial interest, and how much maybe he could get off the price, and playing games there, and I think some similar stuff is happening here. I do think it's there seems to be some bad faith here as well. Using those quote unquote technicalities to get out of things, when it's probably wouldn't have been the case if it was seen as somewhat of a sweet deal.
Mm-hmm. I just look at this and can't help but wonder, was there nobody involved in this deal who would said, what if crypto prices took a 50% hit? Would we still do this, or how do we, and I don't know, maybe there was, but it sure as hell seems like there was nobody who bothered to speak up if that was on their minds.
Well, there's a lot of fanaticism in crypto, that's for sure, and it was going up and to the right for quite a while. But
and the hardcore believers, and I think what's his name, Novogratz is a hardcore believer. Just like you said, Ron, they're looking through very much Bitcoin colored glasses for far too long, and then when they get to a point where probably somewhat going to lose their shirt, or going to be significantly more costly to them, and then they find out these technicalities and be like, oh, we can't do the deal now.
Right. Okay, moving on. I want to talk about, there was a really interesting article, and I have not seen an article like this in a major publication, the Wall Street Journal, again, talking about the banks that are really at the center of the crypto industry. So there's a few banks that are banking the crypto companies. Obviously, these companies have to bank somewhere. And there's Signature Bank, Silvergate, Customers Bank. We know these. We've had several of these. We've had people from these companies speak at our events. These are three of the banks that are really going all in. They are banking. They've had wild kind of swings in the number of deposits. They're not like normal banks that grow their deposit base 2% quarter over quarter. This is, wild 50% swings because they've got so much, these crypto industry has so much cash. Really interesting to kind of see just a little inside scoop on how these banks operate. And some of them have just said, right, we are going to be 100% crypto, like Silvergate has basically taken off all of its other businesses and has gone all in on crypto. But really, I know these banks they're caught up in it, and they're going to be part of this sort of the up waves and the down waves.
Ron, the community banks pretty well. Do you think some of this was driven by losing? I know the article talks about losing market share to bigger banks, and this was a strategy that they thought could give them a segment of potentially the consumers that the big banks weren't going after, and get some value from them, and maybe grow some a loyal customer base. What are your thoughts on kind of what happened here with some of these banks that kind of went all in?
First of all, I don't think this really relates to the consumer retail market at all. I think for a good number of years up until the pandemic, I really think the community banks were ceding the retail market to both the fintechs, the large banks, and the credit unions. It's only really been I think in the past 2 years that I've seen signs that they want to get back into the retail market. And having seen that story, two things kind of hit me. One was, I can't believe there was a CFO in those banks who are willing to let their key performance metrics like swing wildly like that. I mean, some of the stuff was just crazy. And the second being, who are the board members on those banks that went along with some of this? I think to a certain extent, and might be less Silvergate than the other two, that it was a bit of a diversification and an opportunity to kind of jump into a new space and capture it. Somewhat similar to the way some banks and credit unions have tried to capture the cannabis market. These guys were trying to get in early into the crypto market. The Silvergate example, though, where they have kind of gone in 100%, seems like a incredibly risky move on that part. But I don't know them very well, and I'll assume that they knew what they were doing going in.
I think the bigger surprise to me was Signature, which is seen as a pretty well-known name, especially for small, medium-sized businesses. I mean, they're relatively big where I live in New York, in Long Island, and they were the bigger surprise in this move than a Silvergate was, in my opinion.
Mm-hmm. Mm-hmm. Okay, we're almost out of time, but I want to bookend it with another story on the Federal Reserve, because we started with the Fed, we're ending with the Fed. They all, like, this is also crypto related. They basically have told banks, if you want to engage in crypto, you need to be careful. Basically, that's what it's saying. there's several steps you need to take. You need to have different risk management systems in place, yada, yada, yada. They're basically saying that it's okay, but be careful.
I'll jump in. I think this is a great move, and I think it's all good for the banks who want to get into this. And many of them who kind of shy away are afraid, as from not just from the Fed perspective, but for the state regulatory and compliance level and the examiners. And I think this gives them more guidance to go back to, because the Fed has come out and said it. So I think this provides at least a start of the guidelines that many of the banks want and need.
Said it as good as you can right there.
Okay, well, we are out of time, everybody. Thank you so much for watching or listening. We, just as a reminder, at the end of this month, August 30th and 31st, Dealmakers West is happening, and at the beautiful Ritz-Carlton Resort in Laguna Beach. It's going to be a blast, and it's an all-meetings event, no content whatsoever. There are still a handful of tickets left. So if you want to go to fintechnexus.com, sign up there. Anyway, thanks, Ron. Really appreciate you coming on again today. Thanks as always, Todd, and we'll be back next week.
Thanks, Ron.
Later, guys. Thanks.
See ya.